These are the things I watch as a technical trader. Is if we're not getting a bigger move later this month in Bitcoin, I would start to get very, very bearish.
In today's video, Chief Market Strategist of InTheMoneyStocks.com Gareth Soloway tells us all about his latest analysis of the charts as well as his predictions and price targets for Bitcoin. He believes that we could possibly see Bitcoin's low in the coming months. Soloway shares his opinion regarding high inflation rates, the stock market, the crypto market, and the Fed.
Have the floodgates opened for the crypto community here?
Well, it certainly does seem like that. If you look at some of the meme coins that are going nuts, the speculation that's going on in a lot of the cryptosphere, it does seem like the floodgates are opening. But the price action on Bitcoin, while a little bit of a pop today, it's not enormous. It's taking us back to levels we were just at 2 days ago. And I would dare say that we're still stuck in this trading range of around 30,500 to 27,000. And the other thing I would say is that leading into the potential default for the U.S. government, this is when Bitcoin needs to shine. Right? We saw it shine or start to shine with the banking crisis. The potential for a default should be seeing even more price action to the upside. So these are the things I watch as a technical trader. Is if we're not getting a bigger move later this month in Bitcoin, I would start to get very, very bearish.
I haven't seen that yet. I mean, the question is, could we see it now? And then are you sticking to that thesis, or why are you still seeing bearish clouds for Bitcoin?
Yeah, so a couple different things, right? And you're right. Here's the chart. We have that trend line that I had in last time we discussed it, right at that 30,500 level. We pierced it briefly a couple times and then came right back in. And we've really gone into this sleeper mode. If you go back to, mid-March, we're still sideways in this 27 to 30,000 range. So to me, this is a level that is still reminiscent of a bear market rally. If we get above, like I said last time, above that 30,500 level, we can start to talk about maybe the low was 15.7, but as of now, I don't see that, and I still see speculation. I mean, in trading markets, including commodities and cryptocurrencies and stocks and everything else, bottoms are made when there's massive amounts of fear, and people are very skeptical initially when something takes off. With Bitcoin, it hasn't been like that. We've seen the speculation in Pepe coin and all these other meme coins. It's a casino. And that's not the sign of a bottom. In addition, I look at what's going on with the government regulation. The government's purposely holding back regulation until they launch their CBDC, which then brings into the question of, is Tether even worthwhile anymore? Is USDC, is that even worthwhile if you have a CBDC that's basically fulfilling that job? Right. Does that have an impact on the cryptocurrencies as well? And then you go to the stock market. And again, I go back to the speculation, the valuations. Apple's trading at a 28 forward PE. That's ludicrous. We have to see speculation come down. I think the stock market comes down, and therefore it brings crypto down too.
Do you mind overlaying on that chart the S&P? Yeah. So what are your expectations for the S&P? Are you seeing some sort of correction heading into the summer here?
I am. I actually have a very bearish outlook for the second half of this year. I'm actually looking at a correction of as much as 20% in the S&P 500. The charts are telling us this too. I mean, if we just look purely at the S&P 500, in fact, let's go right to that chart right now. What we see is a chart that had a big drop following the 2021 highs in in January of 2022. We saw the big drop. We've then seen complacency take hold. And this is really important for investors to understand. This is the way tops are made. You have this euphoria, which we saw in 2021 in all markets, including stocks and cryptocurrencies. You then have a dip, and then you have sideways consolidation. In fact, let me see if you would just let me bring up this chart of the NASDAQ composite. I want to show you this because I think this is a game-changing chart, and I'm going to put two side by side here. So here on one side, let me bring up the NASDAQ as well. We're going to look at the NASDAQ in two charts. All right, we're going to bring up the weekly chart here and the weekly chart here as well. And what I want to do on this weekly chart, going all the way back, we're going to go all the way back to the 2000 market when the dot-com bubble hit. Okay, now what we see here, look at this. This is just, by the way, Danielle, this is the stuff I live for, right? So what we saw was this down move off of the euphoria, right? We all agree that the dot-com bubble was euphoria. We then had the down move, and then look at the pattern that happened before the bigger move down occurred. And then if we go here, we look at the same sort of pattern formation, right? And so my thesis is that this is just the beginning of a bear market that we are entering in. And if we look at what the NASDAQ did, we know, first of all, the NASDAQ didn't make highs for 10 to 15 years. In fact, I think it was even 16 years. I actually think we're in the same position here where we've had so much bloat due to Federal Reserve printing of money that when this starts to drop, we're going to see the NASDAQ not make highs for probably at least 10 years going forward. But again, the mirror images on the charts are scary here in terms of the 2000 period and what we're currently seeing.
So two things here that I want to help understand. One, is your thesis tied to the fact that you think the Fed takes a pause next and that's what's going to cause markets to rip here or something else?
No, that's basically the thesis of it, is that if you look at, first of all, the cycles, you have a cycle here where we're due for a corrective move. It's been an elongated bull market if you go back to 2009. It's all due to Federal Reserve printing of money and low interest rate policy, essentially they were just dropping money left and right, free money and printing money. The government was sending out checks. And then you look at what's happening now. Yes, inflation, we saw the CPI data come in a little bit, but it's not going to get back to 2%. It's just there's too many issues. The first drop from 9.5% to where we are now at 4.9, that's the easy amount. That's the easy drop. That was supply chain. The problem is wages have gone up. And it becomes very sticky. Once those wages go up, it's very hard to get that genie back in the bottle. So you're looking at inflation that probably stays at 3% for multiple years, and that essentially handcuffs the Federal Reserve. The Federal Reserve is going to be very, very careful and wary of printing money or lowering interest rates with inflation, let's say at 3 or 3.5%, because they're going to worry it's going to be a big pop to 15% as the next result. So without printing of money, this market has not been a real market for a long period of time. And when the investing public realizes that the Fed's not going to come to the rescue, that's when you see real panic set in.
But they've come to the rescue of the banks.
Yes, but again, yes, and you're correct on that. But the key is here is that when you see the rescues for the banks, that's not inflationary, right? They're basically making sure the banks aren't blowing up. They're making sure depositors are made whole, but they're not printing money. In fact, you could argue that what's going on with the banks is actually the banks are tightening credit. The banks are being more careful on lending, which is actually working to tighten monetary policy via the banks. So it's interesting, you're right, that they have come to the rescue of banks, but it's actually worked towards tightening versus loosening policy.
So where is the money going?
So you're right. And right now, let's call a spade a spade. The retail investor is still in the mindset that the Federal Reserve will come to the rescue. All right. So again, we've been conditioned. It's almost like ringing a bell and the dog comes to the food.
Yeah.
The same thing is true for investors. Investors have been conditioned since '09 that the Federal Reserve, any sort of big hiccup in the economy, the Fed will come out and print money. And so what we see buy the dip continuing. We see it in crypto. We see it in stocks out there. And that's creating this false sense of security, or what I call complacency. At some point, that kind of mindset of the investor will shift dramatically. So again, to me, that's where the market has a lot of issues in the future over the next 6 to 12 months. And I think it's important for investors to understand what's really going on here with the U.S. government. The U.S. government is following the Chinese playbook. Now, the Chinese, what did they do? They banned Bitcoin. And they said, okay, let's launch a CBDC, the digital yuan. And they had to ban Bitcoin because they didn't want the competition for the CBDC. They wanted the digital yuan to gain traction and start to be used as a currency, which it is now. It's being intercontinental. We're seeing trade with China being conducted with many countries with the digital yuan, right? So that was their playbook. And now look at what China's doing. China's actually saying, okay, well, now we'll allow people to be involved in Bitcoin again because we have our foothold via the digital yuan. The U.S. isn't about to ban Bitcoin, right? That's not going to happen here. But how are they doing it? They're doing it in a different way. They're not allowing regulation. They're not giving any guidance on regulation. We know, is it a security? Is it not a security? Even Coinbase, right? Coinbase has said, hey, we may have to leave the U.S. They're suing the SEC to get clarity, and the government's just like, nope, we're not going to give you clarity. So this is the way the U.S. government is handling it until they launch their CBDC. So I'm in the full part now. Until we get a CBDC from the Federal Reserve, I don't think you're going to get regulation in the crypto markets in the United States, and that's done on purpose. And in all fairness, I think the Ripple decision with the judge, that's already been made. They're just not allowing that out yet. So when you go to Binance, these are things that the Binances of the world, the Coinbases of the world, they have to do. They might have to end up moving if we don't get this CBDC to be launched and regulation fast enough. So it's a mess, but the bottom line is that there's a real threat. Governments view Bitcoin as a real threat, and they want to get their foothold. China did it. Now the U.S. is trying to do it. Gold is behaving beautifully. You know I've been a huge bull on gold since last year even. And again, what we see is it's now hit what we call a triple top on the chart. A little pause here is normal. Triple tops usually get broken to the upside. So I think you're on the verge of a bigger breakout. Doesn't mean we can't have a pullback to the 1900 level here. But for the most part, if I'm going to be in a place, and we talked earlier about where do investors hide, I think cash is a place. I think gold is a place. And then I think that there are specific areas elsewhere where you can kind of find safety as well. But you got to be very careful about the equity markets as well as the crypto markets.
So wait, you would be long the US dollar here?
I think just as a safety play, yeah. And don't get me wrong, I think de-dollarization is absolutely happening. It's just not something that's going to happen overnight. So if you're looking at a shorter-term holding period, I think being in the dollar, if we see panic across the world, countries are still going to rush to the dollar for safety at this point. Slowly that will change, but it's going to be a 10-year narrative kind of switch over.
Are you sticking to, I think last time 2,300 was your magic number for gold. Have you moved the needle?
I haven't at this point. Doesn't mean if we start to rip towards that sooner than I expect, I want to adjust it. But I think 2,300 would be a perfect target. And then I think in 2024, you're looking at, potentially 27 to 3,000.